Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Welcome back to what I think is going to be a terrific episode of the Second Bite Podcast. Mike Mothner, the founder and CEO of Wpromote, is with me today, and I've been anxious to have Mike on the podcast for a long time. Mike, it's super generous of you to spend some time and insights with us. So thanks for being here.
Okay, great to be here. I always a pleasure.
Excellent. Well, we're going to dig in here pretty quick. I want to quickly thank our friends at TeamShares. TeamShares is a private equity group in New York. They're terrific for founder businesses where the owner wants to retire and move away from his business. Unlike most of the transactions we do, which are second bite type of transactions, you, Mike, have just kind of completed your third bite or completed your second bite and are now focused on your third bite. So why don't we just start with an introduction to you and Wpromote. You've built it over 20 years. Mm-hmm. And then maybe we could start near the beginning, because your first transaction was with Shamrock. And then with that, you took some chips off the table. You're a good partner. You grew the business. Just take us down that road. Tell me the story.
Yeah, sure. So yeah, to your point, very originally, back literally out of a college dorm room in 2001 was the very beginning of Wpromote. For the first 2 years, it was literally just me in college. Really, the beginning of the Wpromote sort of that we've evolved into today. The story began in 2004, and so started just me. Bootstrapped is an understatement. It was like, hey, for month one, it was like our cost is $100. We got to make 110 to stay in business. I mean, it was truly, I always, for many years, I was very confused at like these companies that raise millions of dollars of venture capital and like lose money from it all somehow. Like, I don't know, that sounds fascinating and unique. It was really, it was.
Who was your first customer in 2004?
Actually, I'll tell you, I know exactly what it is. So 2004, we introduced the service basically for the first 4 years of the business, that first arc, 2004 to 2008, we did really just one thing, which is paid search. So we helped, and this is, Google went public in 2004. So these are back, if you remember those days, the wild west of search, of really search engines and search engine marketing being this very, we take it for granted today. It's an integral part of our lives, but the idea that you could have advertising that shows up when specific keywords are searched for is, the most targeted advertising since the Yellow Pages, and 100 times more targeted than that, right? And so the thesis was that we could help businesses that are selling whatever, plumbers, sushi restaurants, e-commerce stores, like anything that you could be searching for, let's help those companies reach their next customer. And so that was the beginning. Our very first customer ever was this woman, Kathleen, I'll never forget, Kathleen Gallant. She had a fingerprinting business, like if you're going to, need a background check. And we had put our own, we had built the website. It was called Wpromote, and the service was search engine marketing. We put our ads on search engine, on Google AdWords, and like an hour later, the phone rang. It was the first time the phone had ever rung.
Wow.
And I answered it. It was my first sales call ever. And it was, in sales parlance, it was a one-call close. So I closed Kathleen Gallant. I got her credit card number. And in the end, I'll never forget, she's like, hey, just one question. You're not just two guys in your garage, are you? And I look around my apartment bedroom where I have my buddy, Mike Block, who's our COO today, sitting on my bed. I'm sitting at my desk, and I'm like, no, we're not in the garage. Yeah. and that was the beginning. And, it's interesting, and funny side note, she actually stayed a client of ours. She had no idea until many, many years later. She was patient zero, right? We didn't really know how to do what we were going to do, and we figured it out with her. She stayed with us for 12 years. Mike Block, who by the time she sold her business, he manages hundreds of people, but he kept directly managing Kathleen Gallant out of like nostalgia. I don't think she ever had comprehended how much we had grown from those days. Yeah. And I think she was, at this point, I think we kept her grandfathered into fees of like $250 a month to us. And at the time that she finally sold her business and was so apologetic that she had to cancel her services because the company she sold it to already did the marketing. And we were like, it's fine, Kathleen. Like, well, we're going to make it.
Yes.
But yeah, that was the beginning. So look at kind of the arcs of the business. 2004 to two. I actually, interestingly, I believe that a lot of businesses really do operate on these kind of growth time periods of 4 to 5 years, which is, interestingly is about a private equity transaction length as well, even though we didn't have that back then. 2004 to 2008, we did one thing, and it was paid search. Kathleen was client, the first client there. Saw very early on that technology and data and understanding measurement and attribution and incrementality was going to be really, really important as this in digital marketing and marketing in general. So
did your mind always work that way, Mike, or did you actually learn that from doing paid?
I think we just, it just always seemed very obvious that you should, if I could demonstrate to a client, hey, you put in $1 and you made $3, you're going to want to invest more in this medium. And the more you invest in it, the more money we're going to make managing a, larger investment, and it's better for you as a business. So I think that intuition was always there. And so this idea of measurement and performance from day one was super key. And the fact that type of measurement was possible, right? It's very difficult to do that type of granular measurement in a newspaper ad, but these ads were actually, it was more measurable then than it is today. It's much harder now with a lot of data challenges and privacy and so forth. Back then it was doable and it was important, and that was a core tenet for us. So that was arc one, 2004 to 2008. 2008, 2012, we evolved into what we called, and we sort of made it up. The term at the time, we called it integrated search marketing. And the thesis was all of the pieces of real estate on a search results page. So you have paid links, you have organic SEO links, you have maps, you have shopping potentially. And if we could, in this now increasingly integral medium of search engines, and in particular, obviously Google being at that point, the by far the
largest,
the largest by a huge margin. And that was really smart. So at that point we start, we're sort of masters of all things search. And this is now, today there isn't a marketer on the planet that search marketing isn't part of what they do. It's just, it's businesses from very small to the world's biggest, they're doing search. And so that was sort of that move. The third arc of the company, and again, we're still kind of bootstrapped and just organically growing, and always had big growth ambitions, and thought that we had, kind of believed that there was nothing, that this was an enormous market, and that we had a different take on it, and we always felt like we had the ability to figure complex things out and keep growing, and that was just that growth mindset. You'll see on our website now we talk about the challenger mindset and so forth. That's very much in our DNA too. I mean, that's the way we approached our business. If we help these businesses grow, that's where our growth comes from. And so it really is, kind of eating our own dog food in that sense.
And so if you think of the end of 2012,
yep.
Roughly how big is the company, revenue-wise or employee-wise? Or
so I'd say, let's see, from 2004 to 2008, went from like 0 to about 5 million in revenue. 2008 to 2012, we probably went from 5 to probably about 5 to 15.
And that's real revenue to you, not past.
Yeah. So we do not count any of our client budgets through that. Right. That number, would be, well, that's in the billions now. That would be in the probably tens of millions then. That's fees to us, probably from 2008, 2012, probably about 5 to 15. 2012 to 2016, the kind of this third arc of growth, we started that, 2012 as sort of this all things search agency or, marketing services firm. And in the next 4 years, we really emerged what we'd call a performance marketing agency or performance marketing platform. So we built out all of the other digital channels. So, email, social, programmatic, started doing what we now call performance creative, continued to build technology and tools to automate reporting and repetitive processes and workflow and measurement, and to start surfacing insights. And the tech and data piece was increasingly part of what stitched all these pieces together. So 2016, we're probably have grown from about 15 to about, probably about 15 to about 35 million in revenue. And probably, I bet at the time we were not super profitable. I think we were really focused on growth. I bet we were, probably maybe 10% profit margins on that back then.
Okay.
So in 2000, and then I'll sort of say this fourth arc of growth that we're kind of just concluded, and we're now on the fifth arc in this, if you go back to the beginning, today. The fourth arc of growth, so call it, 2016, 2017 through, 2022. It's been called 5 years. That was really, that really marked a couple of really big sort of initiatives and goals that we had. The first is we were doing really well for mid-market companies, but felt that larger enterprises were woefully underserved by the traditional holding company agencies. We think they're not innovative. They're not data centric. They're not using technology. They don't understand digital. I think a lot of that is still true, by the way. I mean, they may claim otherwise.
Not alone, right?
A huge amount of our growth the last handful of years has come at the expense of came from business that had been formerly there. So clearly that's the case. I think we are a lot of the holding companies, not just us, but those like us. The headwinds they've been feeling, we're contributing to those headwinds. Their headwinds are our tailwinds, because I think we're just so much better positioned to be impactful for those companies. So that was this one thesis: how do we break into the enterprise market? And there was a talent perspective there. There was a technology. There was, the Forrester performance marketing wave was a moment in time for this. So there was a lot of pieces that had to come together. Partly, we just had to kind of, get an at bat, punch a little bit outside of our weight class, do great work, then use that as a case study and kind of organically. There wasn't one magical moment where suddenly we were like crushing businesses for enterprise. It really happened pretty, 1,000 baby steps. We started down a path of our own M&A, which we can chat about. The thesis there was there are lots of verticals that we're bullish on, that we weren't well known in, and if we could find other marketing services companies or agencies that had footholds in those markets, we could acquire them, make sort of their case studies our case studies, and go and open up opportunities inside those industries. So we did that with and expand geographically. Five years ago, we were really a Southern California-based company. Today, we're very much national, or you could argue international. And we could use this M&A as a way to sort of establish footprints geographically. And we did that. That opened up doors for us in hospitality and travel and financial services, in fashion and apparel and entertainment brands, et cetera.
And were you doing those off of your own balance sheet?
Yeah. So the short answer,
you partnered with Shamrock in 2018.
Yeah. So interestingly, we've done 5 acquisitions. We did 2 of them prior to the Shamrock deal, 3 of them after the Shamrock deal. So we already had a track record of being able to source and close and integrate, which is attractive to Shamrock. They were helpful in continuing to source and get deals done, but we didn't use any additional Shamrocks, although I think they would have loved to put more money in the business. We didn't, we were able to do it with cash on the balance sheet and cheap bank debt and maybe a little bit of equity. That was a way to do it without introducing more dilution to the business for us. And we were able to be pretty scrappy with the way we got those done. But yeah, I mean, the first 2, we just come up with creative ways to put the deal together and spread some payments over time, and maybe a little bit of seller financing, a little bit of equity, and we were able to kind of scrappily get that together.
And did you go out hunting for those, or these were guys you knew and you bumped into at industry stuff?
Yeah, really good question. A bit of both. So, as soon as the first couple just got kind of lucky. They were people that there was a mutual introduction, and somebody kind of knew that we were kind of guys like you, frankly, that we had relationships with. Once you establish yourself as being an acquisitive company, you get very quickly on the radar screens of bankers and other sellers, et cetera, because they want to introduce you to companies. I think the other piece, though, is, this took a long time, and we've made lots of mistakes over time, but I think we became a very attractive place for these companies to sell to, right? We're entrepreneurial. We're bigger than them, but we're not 100 times bigger. You're not selling out to, some, faceless, machine, selling out to the board. We've got an entrepreneurial vibe and a fun personality and a great culture. And so generally the feeling is of excitement. And a lot of times, even though these companies were smaller, we're actually growing faster. And so if they were excited to, if they were excited to be a part of that, there was a cultural fit, and this was great. This was exciting for the people there, for the clients there. And when you get a reputation for being a good place to sell to, it brings good deal flow your way. So
was there one specific thing or two that you heard over and over again that said, this is why Wpromote's a good place to go to?
I think honestly, the culture was big. I mean, I think, we're a place that cares about transparency. We care about growth. We care about our people. And, that is something that reputationally, I think, takes a long time to build. But when you have that, it's one of the most core assets you have.
Right.
So when they did their sort of diligence, I mean, one classic thing that we would do once we had one or two under our belt, say, hey, talk to our other founders that we've acquired, some of which had already, were entrepreneurial people themselves. And a couple of years after went off and left, and we wished them the best, and they started new companies, and we championed that. So, if I think we became an attractive place, and frankly, this meant that we weren't having to compete just on price and structure. We were able to say, hey, this is a great place for your people to land. They're going to have they're going to have more career paths because there's more of an enterprise to climb. One of the challenges in a small company is it might feel like the only growth opportunity you have is to take your boss's job. And if your boss isn't moving, where do you go? In a larger organization, there's just a lot more paths to growth. And we definitely.
And so your first acquisition, roughly how big was the company then?
Yeah, so first acquisition in 2016 was a company called Standing Dog. They were based in Dallas, and at the time we were about 22 million in revenue, and they were about 8 million in revenue. So actually,
wow, big bite.
Wise, that was a bigger percentage increase than the acquisitions we've done recently because we were smaller then. So we were about so that when we did that deal, that brought us to about 30 million in revenue back in 2016. When we did our Shamrock deal, that was early 2018. In 2017, we were 43 million in revenue, just to give kind of an idea. So we've interestingly, the acquisitions helped us grow in size, but that really wasn't the primary motivation. It was, how do we unlock will this help open doors to further growth, right? So, one of our recent acquisitions was Growth Pilots in 2019. They're San Francisco based. They had, one of the areas that they were strong in was entertainment and media. That was an area that we're excited about and didn't have traction in. And we were able to leverage some of the relationships they have. And now we work with entertainment, media, and streaming networks, which has been really big for us. So we've been able to sort of repeat the playbook, and they add size, but really they add strategic opportunity for us. And
so you're about 43. I would imagine EBITDA had probably improved off that 10%.
Yeah. So I think we were, So when we were 43, because I remember this because these were the numbers that kind of informed the Shamrock deal. We were about 43 million in revenue with about 8 million of EBITDA in 2017, which had improved. I think, we had at that time, grew that.
That's a great margin.
From maybe like 10% margins to about, from sub 10% to about, a little bit under 20 was kind of where we were there, probably 17, 18. And the goal with Shamrock was that in 4 years, which is a pretty typical, private equity, generally you'll hear kind of like 3x is kind of what they try to do as I don't say a baseline. I mean, they can do less than that and be successful. But the goal was essentially to sort of triple or more the enterprise value of the company. And so to do that, we set out, because we reflected on these numbers recently in a positive way. I remember we set the goals when we kicked off for Shamrock we called it 120 and 20. And the goal was to grow to 100 million in revenue, 20 million of EBITDA, have 20% growth margins and 20% EBITDA. Those were our numbers. And do that in roughly 4 years. And interestingly, and very excitingly, in 4 years, which was this year, which ultimately informed the transaction that that you alluded to earlier that just closed a few weeks ago. Basically quadrupled the size of the company, versus a little over doubled. We grew, our margins have grown to, 23 or 24%, so eclipsed 20. Our growth profile is north of 30%, and in 2021 was north of 40%. So in each of those sort of 120-20, we were able to significantly outpace what the collective goal was with Shamrock 4.5 years ago, which collectively has made for, a really nice, exciting outcome for them, and obviously, a lot of.
Let me dig into a couple things there. So did Shamrock, were they a majority? Did they take majority?
No. So interestingly, they were a minority deal. So we, I have to get asked sort of like, what was the thought process behind the Shamrock deal? And,
right.
Interestingly, our deal was maybe a bit atypical. But my criteria at the time, to be perfectly honest, I had always assumed, I'm this kind of maybe overly optimistic entrepreneur, optimist. And I sort of, I would positively weight our future at any given point, probably overly positive, right? And I sort of accepted that it's likely that a disciplined, professional investor would probably weight downside, upside a little bit more conservatively than I would. And what that would mean is my idea of at any given point of our valuation, our value as a company might just be higher than any disciplined investor would put a value. And I had
your future value.
Yeah, our future value, or even our value today, based on our high likelihood of a future value. And I sort of accepted that, maybe my naive optimism would mean that I would never overlap with and maybe I'm just wrong with that, but it is what it is. And so, and so interestingly, when what had led to Shamrock, we didn't run a formal process with investment banking, et cetera, partly because I didn't really think that private equity would agree with me on what on my vision on what I thought the company was worth now or could be worth in the future. And interestingly, the story was a really organic one. We at the time had fairly like many other companies like us and in many other industries, pretty regular interest from larger strategics to are you interested in selling the company? Our answer had always been no. At that time in late 2017. There was another one of those moments, and this was a pretty, they were pretty interested. It was a larger sort of traditional ad agency. I really didn't have much interest in doing the deal, but it felt like maybe I'm having blinders on, and maybe I should look at this. And I actually was having breakfast with Steve Royer at Shamrock, and back in the day, I used to have all those private equity breakfasts as a Trojan horse just to get them thinking about Wpromote for their portfolio companies. So we're having breakfast for opposite reasons. He's, cultivating relationships with CEOs and entrepreneurs, and I'm trying to get in his radar screens for digital marketing. Yeah. And, he had asked something like, hey, what's going on? And I shared, well, we have this inbound interest. I don't really want to do it, but maybe I'm being, like I shared, maybe I'm being naive. And he basically is like, Mike, this is what we do. Like we know your business decently well. We invest in it. Maybe we could be a right fit. And so, much to my pleasant surprise, I sort of sat down and I was like, listen, I don't want to give up. We don't really need money on the balance sheet. We're profitable and growing. So my motivation really was to be able to take some chips, a meaningful amount of chips off the table. I'd never done that before. I'd always reinvested in the future. I was starting a family, and it seemed like right time to do that. And partly it was like, hey, this will allow me to stay focused, right? I don't have to take the phone calls when interested parties knock, because I've got a partner, and I can think about 4 years from now and not be distracted and have a good partner that agrees in the vision. So I had sat down at the time and said, listen, I want it to be a minority deal. I really want you to believe in our vision of the future. I don't want, to be pushed to grow too fast or too slow. And kind of here's mathematically what it would mean in evaluation and the way the numbers would work. And they were able to actually kind of make it work, which was great. So I didn't use bankers. Steve and I really did the deal, which is pretty atypical. It was actually a great way to, challenging at the time, but actually a great way to kick off a relationship, because we went from, the challenging part of coming to terms on a deal when it feels like you're on the other side of the table. And then the day the deal closes, you're on the same side of the table, and you got to work together. And so it actually worked really well. I had a great relationship with them. In fact, it was very very bittersweet, this process this year, because they, so we in this case went through a formal process with bankers and looked at a lot of different options. And as you know, Todd, I mean, this is a very challenging, weird year to do a deal, right? This is recession and inflation and debt markets and public markets. And, when we kick things off, almost a year ago, the sort of the planning stages, nobody knew 2022 was going to be the choppy year that it was and continues to be. But
let me rewind before we get into the ZMC, because a couple things I want to unpack. So you and Steve own Wpromote. There's just the two of you.
Yeah. So
I'm sorry, I'm going back to 2018, right before Shamrock.
Yeah. So before Shamrock, I'm the vast majority shareholder. A handful of two key lieutenants that were joined me back in 2004. One was sitting on the bed with me during my first, Mike Block and Mike Stone, that I had brought in as smaller equity partners. And then we had a stock option pool early on for a handful of a couple dozen early employees. So the cap table at the time was essentially 100% employee owned, and with me being the vast majority of them.
I'm wondering, when you get these knocks at the door and all these opportunities and blah blah blah, is everybody supporting you? Like, yeah, Mike, let's just keep going up the mountain, or do people say, hey, Mike, maybe a couple bucks for everybody would be nice?
When I look at these opportunities, a huge part of the lens is, what is this going to mean for everybody else? And I mean that not just the other people that might have stock options or early partners, it's also the people that don't, right? Like, is this transaction with ZMC going to create the opportunity even for those that this isn't necessarily a liquidity event, right? Are they going to be a good partner? Is there going to be great career opportunities? Are we going to be investing in the right places? Like, to the nearly 800 people at Wpromote, I want this ZMC transaction to be a positive thing in the next few years, because we're doing awesome stuff. And so I think it's important. I have looked at that as a priority and I think my general assumption is, or a fair assumption is, if it's going to be if it's going to be a positive outcome for everyone, and it's going to be a positive outcome for, maybe the leadership team that has some upside, and it's going to be a positive outcome for Shamrock, who put in a significant amount of money 4 years ago, then by definition, it's going to be a positive outcome for me, right? If all those things come through, then it's most certainly going to be positive for me as well.
So, question: when Shamrock did the deal, and I'll tell you why I'm asking. A lot of times, private equity groups, to accelerate their returns, will put some debt onto a transaction. Yeah. Did they use some debt?
Yeah, they used some debt. Not a tremendous amount of leverage. I think one of the things, I mean, you know this well, but probably for your audience, it is important to understand the amount of debt that's put on the business, because it dramatically affects. It can dramatically affect. I mean, if it's too much debt, it means the debt service itself could be damaging to the business. But it also, the debt obviously has to get paid eventually, right? So, and the debt gets paid first in a transaction, because they sit at the before any equity holders get paid. So Shamrock put in equity check, which has no debt, but that they get equity for that. Now that's also helpful, I should say, because it allows for less dilution to happen, right? So if part of the deal is funded, so this was provided liquidity to myself and other equity holders, versus money going to the balance sheet, because we really didn't need it. Not all private equity firms are okay with that. A lot would say, hey, we want our money to go on the balance sheet, because then it's actually money in the business versus going to the owners. In this case, that wasn't what we were looking for in the transaction. And we didn't need that, because some businesses need a lot of cash to produce a product. In this case, our product is profitable. So I think so they did put debt on the business. As it happens, because we continued to grow and be profitable, by the time the transaction happened, the debt was paid. And the same, I hope, happens again. There was part of the ZMC deal, there's debt, because that's the mechanics of how these deals, almost all of these deals have some debt. But my hope is, at the point that we go public or have enough transaction in 4 years from now, we will have used existing cash flow to pay that debt. And so that's no longer a burden.
So I had to stop this somewhere. This is a longer episode, and when Mike gave me an hour, I wanted to take every bit of that hour. So I'm breaking it here because it divides the interview really well between the history of Wpromote and then some of the transactions that they did specifically. A couple of things about this that I really liked. I thought it was a tremendous history that Mike and his team had put together, growing from 2004 at $5 million of revenue to this transaction they just did in 2022. They were over $150 million of revenue, well above 20% in EBITDA, and ZMC is going to be a great partner for them. I thought that part was interesting. Also noticed that in the first part of this interview, the transaction they did with Shamrock was not a competitively competed between a bunch of different private equity groups. They found a good partner, made it work with that really good partner. And there's two other episodes you might want to check out. John Morris did exactly that when he sold Rise Interactive, and talks about what it's like to do a one-off transaction or a non-competitive transaction. And then Dean Dutrow also talks about the same thing. You can search both of those at secondbitepodcast.com and just search them, or you can Google their names and podcasts that I'm sure they'll talk about, or you'll be able to find them. And you can hear those guys talk about some of the planning and strategy that goes into a successful transaction with just somebody as a one-off, if you will. So those you can check out. The other thing I think that we are just now getting into, we're going to get into it a lot more in the second episode, is the concept of debt. And a lot of entrepreneurs don't have debt in their business and shy away from it or don't like it. But let me just underscore this really quick. Here's we end up the first half. Let's say that you have a $10 million business. It's valued at $10 million, and somebody's going to give you $7 million of cash, and you're going to roll forward $3 million. That means you'll get $7 million in cash, 30% of the business. What they don't always tell you, though, is that the private equity group oftentimes is going to go borrow money so that they will have that $7 million. So in a different example, as opposed to you getting 7, rolling forward 3, and owning 30%, if your private equity partner uses debt, let's call it $3 million worth, then they're going to put in $4 million. You're going to roll forward $3 million. And then together, you're going to have the debt of $3 million. So now you put in 3 out of 7, not 3 out of 10. 3 out of 7 is 41.6%. It's a pretty big difference between that and 30%. You still get the $7 million. You now just own 41%. You'll hear Mike talk about it in the second half that typically that debt just gets paid back from the business anyways. So I want to just underscore those couple of points. The second half of this episode is terrific, so make sure you tune in for that. Go check John Morris and Dean Dutrow, and feel welcome to reach out and call us if you need to, and if we can be helpful. Thanks.
Thanks for listening to the Second Bite Podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.